you ever looked at the chart filled with green and red candles and thought, what does this mean? Well, you are not alone, but here is a secret. If you understand just a few powerful candlestick patterns, you can easily identify the buying and selling opportunities. In this video, I'll show you the top 7 candlestick patterns that every beginner should know with a simple explanation. So stick with me till the end of the video. Let's begin with the Doji candle. Doji candlestick pattern is formed when the opening price and the closing price are same. The length of the upper shadow and the lower shadow they can vary. Doji represents the neutral candle, meaning equal number of buyers and sellers. And we cannot make decisions in the market and create confusion around the price movement. A doji is it has the same opening price and closing price with a long upper wicks and a lower wicks. Long upper wicks and lower wick. Doji forms near support and resistance. If doji is formed at the resistance, then the price may come down as seller come into picture and they bring the price down. If doji is formed at a support level, then the price may go up, it may increase. The market should be in a downtrend. Last candle must be red, and the candle which looks like a hammer with a long tail formed at the bottom side, then we take a buy position. Buy above the high of this candle, stop loss below the low of this candle, then we enter into the trade and the target will be 1:2. It tells the buyers, it tells that buyers are stepping in after a heavy selling. Then there is a possible reversal and shift in the trend. Next, shooting star. It is exactly opposite to the hammer. A small body with a long upper shadow. Small body with a long upper shadow is the candlestick pattern. If it appears at the top of an uptrend, first the condition is it should be uptrend. If the candlestick is formed at the uptrend, then we can take a short sell positions. The candle which looks like a inverted hammer with a long tail formed at the upside, then we can take a short sell position. The next pattern is bullish engulfing. A big green candle fully covers the previous small red candle. It shows a strong sign of buyers taking control. See, in this chart, first condition is it should be in the downtrend. Market should be in a downtrend. Last candle must be red. Previous candle real body must be covered by the next green candle. Then we take a position. Entry here. The stop loss will be the low of the last or current candle. Then the target will be the swing high, recent swing high, or 1:2 based on your risk. Next we shall see the bearish engulfing. It is exactly opposite of bullish engulfing. A big red candle covers a smaller green candle. It indicates the strong selling pressure. It works at the top of the uptrend and signals possible reversal. Here the conditions for bearish engulfing to spot is market should be in the last candle must be green. The next candle must cover the previous candle's body. Then we take a short sell position or entry here. Stop loss will be the high of the candle entry will be the low of this candle, then the target will be 1:2. It tells the strong selling pressure and possibility of trend reversal. Let's look into the 3 candlestick pattern, that is morning star, a big red candle, a small indecision candle or a doji candle, a strong green candle. It indicates strong trend reversal from bearish to bullish trend. Let us see. First conditions to qualify for morning star is market should be in the downtrend. Market should be in the downtrend. The last candle must be red and the small doji candle in between. The next candle will be followed by green candle, a big green candle. If this pattern is formed at the downtrend, then take a buy position at high of this candle, low will be the stop loss and target will be the 1:2. Next pattern is evening star. It's exactly opposite of morning star. First a strong green candle, then an indecision candle followed by a big red candle. It tells the bearish reversal at the top of an uptrend. The conditions for evening star to be satisfied are: first, the market should be in an uptrend. Last candle must be green. The next candle, all sensitive prices above the previous candle. All prices above the previous candle. Then the next candle will be opened up with a gap down. Then we take a buy position at this low of this candle and high will be the stop loss. Entry will be 1:2. It is exactly opposite of the morning star. If this pattern is formed in an uptrend or at a resistance level, then there is a possibility of the trend shift in the market. Now here is the interesting part. These patterns don't work 100% on their own. The real magic happens when you combine these patterns with the support and resistance level or trend lines. Then only these patterns give you accuracy and you can make profits. For example, if you are spotting a evening star at the resistance level, for example, if you spot this candle, evening star candle at the resistance level, then the accuracy of this pattern will be high, and then where you can enter the trade. If a morning star is found at the support zone, then that gives more accuracy and you can enter the trade. Firstly, you have to check the trend before trusting pattern. You cannot trade on just based on the patterns. You have to check the trend. Then use when these patterns are formed at a resistance level or trend lines or at nearby the moving averages, indicators like RSI, moving averages, then the accuracy of those patterns will be high. Don't trade just only based on the candle formation. Wait for the confirmation. Practice by marking these patterns on the historical charts. If you found this useful, please do subscribe my channel for more stock market learning videos, and let me know in a comment which candlestick pattern do you want me to explain in detail with the real-time chart examples. And remember, learning to read candlestick pattern is a first step to become a confident trader. Keep practicing, stay disciplined, and I'll see you in the next video. Thank you.